There's a signal emerging across global markets. It's a subtle one, and it doesn't have the usual signature of a risk-on rally. Instead, it seems to suggest a quiet but very fundamental repricing of institutional credibility. What follows is our analysis of that signal and the erosion of trust it implies.
So the first thing to look at is the persistent strength in gold. It's been trading at or near nominal record highs. Now, if you look at this in isolation, you might chalk it up to a number of cyclical factors. But the monetary environment we're in right now is anything but isolated. In fact, it's deeply contradictory. And that forces us to look much deeper at what's really driving this.
Our analysis here suggests that this market behavior isn't some lagging reaction to the latest economic data. It appears to be a forward-looking verdict on the constraints that central banks are now facing. The market is beginning to price in a future where policymakers' control over their own objectives might be structurally compromised.
So it's absolutely crucial to distinguish what's happening from, say, speculative froth or just a knee-jerk reaction to inflation numbers. What we appear to be observing is a deliberate, quiet repricing of a very specific tail risk, the risk that the very foundations of monetary policy are becoming unstable.
So let's start by examining the abnormal signals that are showing up in the market right now. The way key assets are deviating from established economic models, well, that's where we'll find the most important information. The current landscape presents several really significant contradictions. First, you have gold making new highs during a restrictive monetary policy. In theory, high interest rates should be suppressing its price because of the opportunity cost. Second, we're seeing early signs of silver, a much more volatile monetary metal, starting to outperform gold. At the same time, bond yields aren't reflecting full confidence in the Fed's long-term stance. And finally, the US dollar isn't showing that clear, unambiguous strength you'd typically associate with a tight policy cycle. Each one of these is interesting on its own, but when you put them together, they point to a single, coherent concern in the market.
What this price action really tells us is that there's been a fundamental shift in the market's calculus. You see, the traditional framework says holding a non-yielding asset like gold is unattractive when government bonds are offering high returns. So when capital flows into gold despite that high opportunity cost, it signals a change in motivation. The priority is no longer the search for yield. It's shifting to hedging a specific kind of fear.
And that brings us to the central conflict of this entire environment, this widening gap between what central banks are saying and what the market believes they can actually do in the future. This is the credibility paradox. The Federal Reserve's last policy decision was, well, it was unambiguous. Interest rates were held steady. The official language gave no hint of a pivot towards easing, no suggestion of a cut. On paper, this is a hawkish, anti-inflationary stance. It's an action that should have strengthened the dollar and put pressure on precious metals. But the market's reaction told a very different story.
And this is where we see the paradox. On one hand, the Federal Reserve is communicating a restrictive policy stance, but the market's price action is delivering the opposite verdict. It's suggesting a belief that this tight stance simply isn't sustainable over the medium term. You see, the market isn't reacting to the policy of today. It's pricing in the forced compromises of tomorrow. It is, in effect, a vote of no confidence in the durability of the current policy.
So, where is this market doubt coming from? It's rooted in several underlying factors. Real yields, when you adjust for inflation, just aren't restrictive enough. Inflation expectations are still stuck above the central bank's target. And, most critically, the fiscal picture keeps getting worse. The rising cost of servicing government debt creates a direct conflict with tight monetary policy. And, on top of all that, the political tolerance for the pain of high interest rates is visibly shrinking. The central bank's independence is being tested.
And this political dimension, it's not just background noise anymore. It's now acting as a primary accelerant, actively widening that credibility gap between the institution and the market. You know, a central bank's theoretical independence is its most critical asset. But that independence, at the end of the day, is a political construct. It relies on a general agreement that monetary policy should be kept separate from election cycles. When that agreement starts to fray, the central bank's effective power gets smaller, not because the economics changed, but because its real-world constraints have. Now, there's a technical term for this kind of pressure. It's called fiscal dominance. This describes a state where the government's fiscal needs, the need to fund its spending and service its debt, become the main driver of monetary policy. The central bank is essentially forced to keep interest rates lower than it should, monetizing the debt to keep the government solvent. This is the outcome that markets are now starting to price as a real possibility. So to be clear, the market isn't reacting to any one political statement or personality. This is a cold, probabilistic assessment. Overt political pressure on the Fed, no matter where it comes from, simply increases the calculated probability that policy will be compromised in the future. Gold isn't pricing rhetoric, it's pricing the rising odds of a forced policy error.
So this brings us back to gold, in the very specific function it's playing in portfolios right now. To really understand its behavior, we have to reframe its role. It's more than just a simple hedge against consumer price inflation. In this environment, gold is acting as a trust hedge. This is an allocation you make not against a rise in the CPI, but against a decline in the perceived competence and independence of the institutions that manage the currency. It's insurance against the risk of systemic policy mistakes that are born from political pressure and fiscal need.
You see, gold's role in a portfolio shifts during periods of institutional stress like this. It becomes less of a simple diversifier and more of an early warning system. Its signal is often subtle, and it usually comes before we see confirmation in the official economic data. It's a quiet accumulation of capital that senses instability on the horizon. And this is a really critical distinction to make when you're interpreting this market. Sophisticated capital doesn't wait for a central bank to officially give in to political pressure. It doesn't wait for inflation expectations to break free. It acts preemptively, pricing in the risk of those events. The strength we're seeing in gold right now is not a reaction to something that happened. It's an anticipation of something that might.
Now, if gold provides the early warning, then silver can be seen as an indicator of more acute stress. Its behavior gives us a different and often more urgent layer of information. So where gold's signal is often a low-frequency warning, silver's can be a sign of acute market stress. Its dual nature, as both an industrial and a monetary metal, makes it highly sensitive to shifts in both economic expectations and monetary fear. When it starts to move with real velocity, it demands close attention.
Historically, the gold-to-silver ratio is a very closely watched indicator of systemic stability. A sustained period where silver outperforms gold often lines up with late-cycle dynamics, rising inflation, and critically, liquidity stress in the financial system. It can suggest that market concerns are shifting from a long-term strategic problem to a more immediate tactical instability, and we are starting to see the early signs of that outperformance now.
Okay, so given this diagnosis, where do we go from here? We need to turn to a forward-looking analysis of the potential paths. This situation isn't static. It's a dynamic of pressure and institutional response.
We see three primary scenarios evolving. In the first, the Fed tries to hold its restrictive line while political pressure gets more intense. In that kind of high-tension environment, gold would likely continue to grind steadily higher, while silver would be highly volatile. In the second scenario, the political or fiscal pressure forces premature rate cuts. That would likely trigger a sharp repricing everywhere, with a weaker dollar, a jump in inflation expectations, and a significant explosive move in both gold and silver. The third scenario is a temporary calm, maybe some profit-taking. But even in that case, the underlying structural problems would still be there, providing a firm floor of support for hard assets.
The critical insight from this scenario analysis is that the fundamental role of gold appears to have shifted. Across all of the most probable paths, its function is not one of speculation, but of essential portfolio insurance. The relevant question is no longer if you should have exposure, but how that exposure is likely to behave under these different degrees of systemic stress.
It's useful here to distinguish between two levels of market analysis. The surface level, the retail focus, is often on the headlines, political statements, the latest inflation print. Institutional capital, however, is focused on the underlying pressure points, the sustainability of government debt, the true independence of the central bank, and the long-term stability of the currency itself. The price action we're seeing in gold and silver is a direct reflection of these deeper, structural concerns.
The narrative of this economic period is being written in real time, but the most reliable historical marker might not be found in the minutes of a Fed meeting or in the text of a political speech. It will be found in the price of assets that are independent of policy promises. The signal of this era's defining challenge, this conflict between political necessity and monetary discipline, is not a statement. It is the rising price of gold.